Do you ever wonder how to decipher the language of financial statements? Today, we dive into a comprehensive guide on reading, interpreting, and analyzing corporate financial performance. Unraveling the numbers can unlock a treasure trove of insights. From balance sheets to income statements, each line tells a story of a company's health and trajectory. Let's journey through the maze of numbers, uncovering patterns and trends that reveal the pulse of a business. Think of financial statements as a roadmap, guiding us through the twists and turns of economic landscapes. By the end, you'll be equipped to navigate the financial terrain with confidence and clarity. Remember, understanding financial statements is not just about numbers, it's about decoding the narrative behind them. Welcome to our course overview. Today, we delve into the world of financial statements, the vital language of business. These statements reveal a company's financial story, its health, performance, and potential. Throughout this presentation, we will break down the 4 core financial statements, empowering you to analyze them with confidence. We start by mastering the structure and purpose of each statement. Then, we dive into key components like revenues, expenses, assets, liabilities, and equity. Next, we tackle financial analysis, equipping you to calculate and interpret critical ratios effectively. Finally, we bridge theory to practice, applying your newfound knowledge to real-world scenarios. Get ready to unlock the secrets of financial statements and enhance your financial acumen. Ever wondered how to assess a company's financial health in a snap? Enter the income statement, also known as the profit and loss statement. This financial report tracks a business's performance by subtracting expenses from revenue to reveal the bottom line, net income. It's like a report card for a company's success over a defined period, be it a quarter or a year. Revenue in, expenses out, the math is simple, but the insights are invaluable. Think of it as a profit pulse check. Ever wondered how a company's income statement unveils its financial story? It all starts with revenue, the total sales from products or services. Next, gross profit emerges as revenue minus cost of goods sold, shedding light on the company's profitability. Operating expenses then reveal the costs of running the business, leading to operating income, the profit from core operations. Finally, net income stands as the bottom line after all expenses. This structured flow helps pinpoint where a company thrives or struggles financially. From revenue to net income, each component paints a unique picture of the company's financial health. Ever wondered how a company's financial health can be captured in a single moment? Enter the balance sheet. Unlike the dynamic income statement, the balance sheet freezes assets and liabilities in time, akin to a financial snapshot. Picture this: assets equal liabilities plus equity. This equation, always in perfect harmony, is the backbone of the balance sheet, revealing how everything a company owns is funded, through debts or owner investments. It's a financial portrait painted on a specific date, showing the intricate web of a company's financial structure. Ever wondered how the balance sheet structures financial information? Assets lead the way, ordered by liquidity, how fast they can turn into cash. Liabilities follow suit, lined up by their due dates. And then there's equity, the owner's slice after all debts are settled. It's a financial roadmap that tells a story of a company's strength and obligations. Think of it as a snapshot, capturing a moment in time, revealing the financial health and obligations of a business. Ever wondered how a company can be profitable on paper yet run out of cash? Enter the cash flow statement. This financial document tracks the actual movement of cash in and out of a business, not just its profitability. While the income statement tells one story, the cash flow statement reveals another: the company's liquidity, its ability to meet financial obligations. Think of it as a reality check on whether there's enough cash to pay the bills. It's not about accounting concepts, it's about cold, hard cash. So, remember, profit isn't always cash in hand. The cash flow statement helps us see the difference. Ever wondered how a company's cash flows are categorized and what they reveal about its financial health? Let's dive into the 3 main types of cash flows. First up, we have operating activities, where the cash flows from day-to-day business operations, like money received from customers and paid to suppliers and employees, as well as interest and tax payments. This section is crucial as it reflects the core business's ability to generate cash. Next, we move to investing activities, where cash is used for future investments such as equipment purchases, property acquisitions, or selling long-term assets. It's common to see negative cash flow here as companies invest in growth opportunities. Lastly, we explore financing activities, involving cash from investors and creditors, debt issuances or repayments, stock issuances, dividends, and share buybacks. This section sheds light on how the company raises capital and returns money to its owners. In essence, understanding these three types of cash flows provides a comprehensive view of a company's financial operations, growth strategies, and capital structure. Ever wondered how a company's equity evolves over time? The statement of changes in equity, also known as the statement of stockholders' equity, holds the answers. This statement acts as a bridge between balance sheets, detailing all shifts in the equity section. Net income boosts retained earnings, dividends reduce them, stock issuance increases common stock, while stock repurchases shrink equity. Additionally, special gains or losses from other comprehensive income play a role. Consider this statement as a dynamic snapshot of a company's financial story, illustrating the ebb and flow of its equity components. Ever wondered how the financial statements connect to tell a complete financial story? Let's unravel this interconnected web. The net income from the income statement flows into both the statement of changes in equity and the cash flow statement, influencing retained earnings and operating cash flow, respectively. The cash balance at period end from the cash flow statement transitions into the cash asset on the balance sheet, ensuring consistency across all financial reports. These linkages are vital for a thorough financial analysis, providing a holistic view of an organization's financial health. Ever wonder how businesses track their money? Revenue is the cash flow from selling goods/services, recorded upon earning, not just when cash is in hand. Think product sales, service fees, and more. On the flip side, expenses are the costs to make that revenue happen. From salaries to marketing to rent, every dollar spent plays a role. So, how do these puzzle pieces fit together? Revenue and expenses work hand in hand to paint a picture of a company's financial health. Remember, revenue is the what, and expenses are the how. Ever wondered about the nuts and bolts of a company's financial structure? Assets are the powerhouse resources that fuel future growth, think cash, inventory, or patents. On the flip side, liabilities are the debts and obligations that need settling, like loans or accounts payable. Assets can be current, easily convertible to cash, or non-current for the long haul. Liabilities create claims on these assets by creditors, demanding future payment or services. It's a balancing act between what a company owns and what it owes, shaping its financial health and stability. Remember, assets bring hope, liabilities bring responsibility. Ever wondered what equity really means in the realm of finance? Equity, also known as stockholders' equity or shareholders' equity, is the residual interest owners have in a company after deducting all liabilities from assets. Think of it as what would be left for owners if everything was sold off and debts were paid. Contributed capital is the money owners invest when buying stock, encompassing common stock and additional paid-in capital. Retained earnings are the accumulated profits kept in the business instead of being distributed as dividends. Other comprehensive income includes gains and losses not part of net income, like foreign currency adjustments and unrealized investment gains. Remember, equity equals assets minus liabilities, reflecting owners' growing claims on the business as it prospers. So, as a company grows and profits accumulate, equity typically rises, illustrating the increasing value of owners' stakes. Ever wonder how effectively a company turns revenue into earnings? Profitability analysis holds the key. A 15% net margin signifies a healthy business, while a strong 40% gross margin reveals pricing power. With a solid 20% return on equity, value flows back to shareholders. These metrics aren't just numbers, they paint a clear picture of a company's performance, aiding investors and managers alike in making informed decisions. It's not just about the numbers, it's about the story they tell. Ever wondered how to truly measure profitability in a business? Let's dive into the key ratios that unveil the inner workings of success. The gross profit margin paints a vivid picture of pricing power and production efficiency, showing the company's ability to retain profit after covering production costs. Moving on to the net profit margin, we unravel the company's overall operational efficiency and cost control, revealing the essence of profit generation. Lastly, the return on equity metric unveils management effectiveness and shareholder value creation, demonstrating how effectively owners' investments translate into profits. These three ratios, like puzzle pieces, come together to form a comprehensive view of a company's financial health. Remember, understanding these ratios is not just about numbers, it's about deciphering the story they tell about a business's prosperity. Ever wondered why liquidity matters in analyzing a company's financial health? It's the lifeline that ensures a company can meet its short-term obligations. Even profitable ventures can falter if they can't settle immediate debts. Strong liquidity isn't just about surviving tough times, it's also the key to seizing opportunities. Creditors and suppliers keenly watch liquidity to gauge credit risk. A 2-to-1 current ratio signals robust short-term financial health, while a 1-to-1 quick ratio indicates the ability to meet immediate obligations. Remember, in the financial world, liquidity is king. Liquidity ratios are vital for gauging a company's financial health. The current ratio, dividing current assets by liabilities, indicates the ability to cover short-term debts. A ratio above 1.0 is positive, with 1.5 to 2.0 considered healthy. The quick ratio, excluding inventory from assets, shows readiness to meet obligations with liquid assets. A ratio of 1.0 or higher signals strong liquidity. The cash ratio, using only cash and equivalents, assesses immediate debt payment capability. Working capital, while not a ratio, highlights the excess of short-term assets over liabilities. Positive working capital is crucial for financial stability. Remember, liquidity ratios offer crucial insights into a company's financial flexibility and solvency. Let's dive into our analysis of TechCo Incorporated's financial health. With revenue at $5 million and solid cost management, they achieved a net income of $1.05 million. Their balance sheet reveals $2.4 million in current assets and a healthy current ratio. Calculating key ratios like gross profit margin, net profit margin, return on equity, and current ratio will give us deeper insights. Is TechCo profitable, able to cover short-term debts, and adding value for shareholders? These numbers paint a promising picture, but let's crunch the ratios to uncover the full story. Dive into TechCo's financial prowess. A 60% gross profit margin showcases their pricing power and efficiency. With a net profit margin of 21%, cost control is stellar. Strong ROE at 21% signifies top-notch management. Their current ratio of 2.0 signals robust liquidity. TechCo shines with profitability, management finesse, and financial stability. A recipe for continued success in the business arena. As we wrap up, let's revisit our journey through financial statements. Remember, each statement plays a crucial role in telling the financial story, from income to equity. The core components, revenue, expenses, assets, liabilities, and equity, are the foundation of financial reporting. By delving into financial ratios, we gain valuable insights into company performance. Practical analysis allows us to apply our knowledge to real-world scenarios. Now, let's test ourselves with some practice questions. Which statement reveals a company's ability to pay bills next month? A high gross profit margin but low net profit margin may signal what? Even profitable companies can face cash flow challenges. Why might this happen? And, can you calculate ROE with net income at $500,000 and equity at $2 million? Remember, financial statements are the scoreboard of business. Master them, and you'll grasp the game.